Hi, everyone. My name is Rebecca Fishman-Lipsey, and I'm the president and CEO of the Miami Foundation. I'm so excited to welcome you all to our second annual investment briefing. This conversation is very important to us. You're very important to us. And I'm excited for us to have some time with our experts. Last year's briefing, our world was in a completely different place. I don't need to tell you all that over these last few months, the way that we do business has changed. The way we shop for grocery has changed. The way we educate our kids has changed. The way that we give has changed. And over here at the Miami Foundation, we are immersed in the middle of the largest nonprofit relief program that we've run since Hurricane Andrew. We are helping hundreds of nonprofits to sustain through this crisis. We've given out hundreds of thousands of pieces of PPE. We've helped connect families with Wi-Fi who don't have access so that their kids can go to school. And we're attempting to raise more money than ever before on Give Miami Day to make sure that our nonprofits end the year strong in the face of everything that's going on. And all of that is only possible because our community is tremendously generous, especially in moments like this. And your dollars, your philanthropic dollars, are precious for our community, and we take our responsibility very seriously to make sure that our philanthropic investments for our community are strong. And we are just so grateful to our investment committee and to our partners who have tirelessly convened to make smart decisions over the course of a very complicated fiscal year. And I want to thank our investment committee. I want to thank our board members, who I know many of them are tuned in today. And I want to thank all of you for taking the time to think about the power of your philanthropic dollars in this moment and the ways that you can make sure to protect those assets as much as possible in this moment. And to our panelists, I want to thank you for your wisdom and for your time today. It's our most precious commodity, is our time. And so thank you for giving us some of yours. We have thousands of donors and hundreds of nonprofits that are doing really important work in the community right now. And so I want to leave you all with just one thought before I pass the mic over to our panel today, which is that community investment and community strength is a team sport. And there are so many people working towards community impact, often in silos. And our core effort over at the Miami Foundation is to bring together people who want to see a stronger Miami to help us accomplish that together in ways that we couldn't do by ourselves. Philanthropists and nonprofits and elected leaders, for us to bring our power together to really create change with one another. And so I thank you for being a part of our team and for allowing us to be part of yours. And wishing you continued strength and health. And with that said, I'm delighted to pass the mic over to our moderator and to our panelists to introduce themselves. So Julie, I'm going to pass the Zoom mic over to you.
Thank you, Rebecca, and good afternoon, everyone. And we know how busy you all are, so very much appreciate you spending a little bit of your time with us today. I am Julie Neitzel, as Rebecca just referenced. I am the vice chair of the Board of Trustees, as well as the chair of the investment committee. I'm fortunate in that in my 25-year plus background, I've dealt with investment issues across many different types of pools of capital, from large foundations, endowments, to really family capital, which is very much like an endowment approach. I can't think of anything more profound and important in terms of the time and dedication that I have to the Miami Foundation, because while we're here today to talk about the financial capital that the Miami Foundation oversees and has a fiduciary role in protecting for the endowment and for all of our fund advisors, what this is about is really investing in the social and intellectual capital of our Miami community, which ultimately has the best return for all of us. So I'm thrilled to be here today with each of you and be your moderator. And I'd now like to have my other fellow panelists introduce themselves before we get into the program.
Thank you,
Angela, if you would kick it off, please.
Yes, thank you, Julie, and thank you, Rebecca. My name is Angela Carrillo. I am a professional advisory committee member of the Miami Foundation. I currently work at JP Morgan Chase as the lead trust officer for all of Florida. I've been in banking for 18 years. also serve as the president-elect for the Junior League of Miami. So I'm very much involved in the philanthropic world, and I'm happy to be here today. Thank you.
Thank you, Angela.
I am Joe Fernandez, and I am a managing director with Field Point Private Securities and Field Point Private Bank and Trust. I have been associated with the Miami Foundation for probably 6 years as a member of the board, former vice chair, chair of development and programs, and for a brief moment in time, the interim president and CEO for late 19 and early 2020. I'm pleased to be here, and I'm a huge fan of everything the Miami Foundation does.
Thank you, Joe. My name is Glenn Harris. I work with SEI Investments, and I've been overseeing the investment management services and pools on behalf of the foundation now for going on my 8th year. So I'm proud to say I've had a long-term relationship with the Miami Foundation. I currently work with about a dozen nonprofits across the United States, especially focused on the community foundation world. So I've been doing this now for over 25 years, and I look forward to giving all of you an update on the markets and the portfolios in just a matter of time. Thank you.
Thank you, Glenn. And Glenn and SEI play a very important role for the Miami Foundation Financial Capital, and that they're our external investment advisor. And given that they work with many community foundations and institutions across the nation, they bring best practice insights to us, as well as many resources that have been absolutely essential in helping us accomplish the results that we have with the foundation, which you're going to hear about in a minute. One of the things I just wanted to kick off before Glenn takes you through more specific detail is, as many of you know, 2020 has been a quite unusual year in the markets. Volatility would be an understatement, but nonetheless, it was a year that required attention, focus, particularly of this investment committee. And so one of the questions was, well, what did we do, over the course of the volatility, and how did the Miami Foundation Investment Committee respond? Well, just very high level, just with any investment portfolio, first and foremost, we needed to make sure that we had adequate cash on hand to meet the grant making requirements. And as you know, in a time of need where we are today, that was absolutely key critical. But really throughout this tremendous market volatility, we met every week without fail. And every week we went through what was happening in the markets. We did a deep dive on specific investment managers, strategies, asset allocation of the foundation, and did that for a series of probably about 3 months as we worked our way through the market volatility. And it was really critical to satisfy ourselves, on several fronts. One, do we have the right asset allocation across the different investment pools? Is there anything that we're doing today that we need to fundamentally revisit and change? And 3, are we satisfied in terms of the investment outcomes that are happening, given what's happening in the broader global markets? And so a lot of time and attention was focused by this investment committee, and I do appreciate SEI's time in that regard, as well as all the members of the investment committee. One of the key things I mentioned was revisiting asset allocation, and we're going to go through this in a minute. But those of you that are in the investment business know that 90% of your investment returns are going to be predicated on making sure you have the right asset allocation. And, I'm pleased to say that I think we've done a good job with SEI's help in that regard. And so with no further ado, I think it would be beneficial for me to pass the program over to Glenn Harris. That's going to take you through a little bit more detailed slide deck of really exactly what we're doing within the foundation portfolio and investment pools. So over to you, Glenn.
Well, thank you, Julie. That's a very, very nice summary in terms of what we've been doing together, which seems like a really long time now, considering we're here in late October and everything started back in the first quarter of this year. So as far as who is SCI, just to take a couple seconds to talk about our background here and what we do for the foundation. SCI has been providing OCIO services. OCIO stands for Outsourced Chief Investment Officer for more than 25 years now. Julie noted some of the clients that we work with. We have over 177 clients now worldwide. And I think what's a really important statement is the fact that our clients, almost half of them, have been with SCI for more than 10 years now. And many of our clients have actually been with us for more than 20 years. And I think a part of the reason why that is the fact that we've got a significant amount of investment and infrastructure in place in terms of not just managing clients' portfolios, but also the amount of research, risk management tools that we put into play on behalf of all our clients. And I'll talk a little bit more about that in just a second. Some of the things you're going to hear me talk about this afternoon are, as Julie noted earlier, 2020 has been a very challenging year, but interesting enough, markets have been very resilient. And there's this possibility that they can continue to be resilient as we continue on here in 2020. So the other thing I want to point out, though, too, is that this year has been uncharacteristically being led by a very small group of companies. I think many of you know exactly the companies I'm referring to, the so-called FANG index. So some of our largest companies here in the United States have been doing very, very well. And from SCI's perspective, we think that some of those companies are getting quite expensive right now. And we do believe that at some point, we're going to start to see a rotation out of some of these large cap mega tech companies and likely into other areas that have been struggling, not just due to COVID-19, but also just as a reflection of investors favoring the technology marketplace. And so what I mean by that is maybe looking into financials, energy, some select consumer type companies. And so we would encourage our clients and investors not to necessarily get caught up in the fad and chasing trends. It's not to say these companies aren't good. It's just at the end of the day, what we're looking for is companies that have strong underlying fundamentals and have reasonable valuations. And I'll talk a little more about that in just a second. Julie did a really nice job talking about everything that we've been doing behind the scenes on your behalf over the course of 2020. And the one thing I would point out as well and add to that conversation is the fact that back in March, when we really had no idea what was happening with respect to the financial markets, recognizing how quickly the virus was spreading around the world, especially here in the United States, it's kind of a hard decision. When do you actually buy more into certain investments? When do you sell investments? And so one of the things that we did towards the middle of March was we took the opportunity to actually buy a little bit more into the equity markets. We didn't completely fill back up to our targets, but we took what I call a partial rebalancing, taking advantage of some companies that we really liked that were being sold off dramatically. And that actually paid off quite well. You can see here one of the bullet points highlights that by buying into equities, we actually reap the benefits of the S&P 500 and the MSCI All Country World Index actually posted positive returns of almost anywhere between 5 and almost 6% in that last week of March. So that proved to be very favorable timing, and not to mention the fact that markets improved over the following 2 quarters after March. So that was just an example of some of the activity that we took place during the month of March. I think this exhibit is really interesting in the sense that I was just talking earlier about the FANG trade. And so this page is showing you 2 squiggly lines here on the far right-hand side. Everyone knows what the FANG trade has been, but another term that you might be hearing about is a pandemic trade. And so as everybody was locked down, working from home, staying at home, there was a large selection of companies that also contributed to the rise in market performance. And many of them are footnoted here on the bottom right corner, but I think many of you know what I'm talking about. How many people went to the store and loaded up on Clorox wipes or went to Home Depot to start some home improvement projects? And the list goes on, but these are the types of names or companies that have done very well over the course of this pandemic here in 2020. So as I noted earlier, what we really are betting on now is as we get to this point where we start to hear more about vaccinations, and the key thing is they need to be safe, need to be reliable, and people have to be willing to take them. And so if we start to see that come to fruition, what we're hearing now is likely maybe the first half of 2021, then at that point, you could start to see what we're calling a reopening trade. where you start to see more cyclical, more economically sensitive companies that have attractive valuations. That being the key point, because again, a lot of these FANG and these stay-at-home stocks, they're great companies, but from a valuation perspective, we think they're kind of expensive. And so that's why we're going to be getting ready to buy into some other areas that have been beaten down. Again, with the bet that there will be a vaccination at some point. The other thing that might be on your minds is the presidential election. I know we're only a couple weeks away from this interesting time period. And then this is just an interesting slide to share with you what has happened to the stock market being represented by the S&P 500 1 month following the outcome of the election, and then what happens in the following calendar year. And so I think really the key takeaway here, is, if it's anything just more than interesting data points, is the fact that it is impossible to forecast what is going to happen in the stock market over the next month or over the next year for that matter. And so what's interesting here on this page also is the fact that in most cases, the stock market has performed fairly well, especially over the last couple of decades, with the exception of 2008. And that was nothing against President Obama. That was purely a reflection of the environment we're in. You might recall the great financial crisis that started in September of 2008. And from that point on, the markets sank pretty considerably. And so that's really a point in time. So the other key point is it's more about the economic fundamentals is what we care about at SCI. We're watching all the underlying economic data because that's really what's going to drive stock market performance going forward. Our biggest concern, as it relates back to the election, I would say, is if it's a contested election. We're hearing about the concerns about mail-in voting. And by contested, I'm referring to what if we don't have an outcome on the day of the election? What if it takes another month or two and it has to be pushed up to the Supreme Court, like back in 2000? So that's obviously a concern for us. Why? Because if you have a contested election, that's going to lead to a lot more volatility. And what do you do with your portfolios during that time period? And so what I would say more recently is we've been putting some risk management plays into the portfolios. What I mean by that is adding a little more conservative fixed income, again, very modestly, also further diversifying into some of those undervalued companies that I was talking about earlier, and then also maintaining some exposure to lower beta or lower risk investments. So getting to the performance, this page here highlights each of the individual pools and shows you by quarter how each one of them performed. And so, as I noted earlier, back in the first quarter, you can see it was a significant drawdown across all the pools, whether it was the long-term, the balance, the income, the social impact. The index pool actually wasn't up and running at that point. You can see on the far right-hand side of when the inception dates were for each pool. And so the index pool, actually the timing was pretty good here, highlighting that fact that the pool was launched at the very end of the first quarter. And that's why you're seeing the strong recoveries in the second and third quarters of this year. And so across the board, you'll see that the pools after the first quarter came back pretty strong. And more interesting, in the third quarter, the long-term pool outperformed all the other pools. And so from our perspective, what's been happening over the last couple of quarters is the long-term pool tends to have a higher exposure to alternative investments, whether it's private equity, whether it's hedge funds, whether it's energy debt. Those types of strategies are typically reported on a lag, right? So whether it's one full quarter, whether it's a full month. And so it's taken some time for those valuations to become available. And so what you're seeing here on the second to right column where it says since inception, these are returns going back to the respective inception dates. And so you can see that the returns are really right where we would expect them to be. We would expect the long-term pool to have the highest rate of return based on the fact that it has the highest exposure to equity and other riskier investments to generate higher returns over longer periods of time, followed by the social impact pool and the index pool. Those two pools also have higher equity allocations, whereas the balance has a little bit less in equities, and the income, of course, is much more conservative with a very modest allocation in equities. And so I will talk a little more about returns in just a second, but I also want to highlight, it's not just so much how are the pools doing in terms of absolute terms, but how are we doing versus a peer group? And so Julie noted earlier about working with other community foundations. So there's a pretty well-known study that's conducted each quarter for community foundations across the United States in terms of how they perform. It's a voluntary survey that's conducted by Colonial Consulting in partnership with the Fiscal Administrative Officers Group. And so, by the way, September 30th is not available just yet. That's why I'm showing you June 30. But the purple bar is basically the performance of the long-term pool. The other two bars, lime green and aqua blue, are showing you all participants in that respective survey, followed by those community foundations that have assets between 100 million and 250 million. And so in either case, you start looking at the longer term numbers here, 5 years, 7 years, these are annualized net of fee returns. You can see that the long-term pool has had competitive performance, not just on an absolute basis, but also relative to a peer group. The other question that I know that came in prior to today's meeting was, what are the expectations? What are the forecasts for the returns of each of the pools, especially the long-term pool, over the short term, whether it's over the next year, over the next 3 years, next 5 years. And as I noted earlier, it is quite difficult to forecast exactly what the returns will be. But what this page is showing all of you, and I put all the pools here intentionally, is to kind of estimate what the returns could look like in any given year. So it doesn't mean these are going to be the returns in every year. It's showing you a range of outcomes. And how we come up with these numbers is we conduct Monte Carlo simulation using capital market assumptions for all the underlying asset classes in each respective pool, and then run different scenarios and base it all on probabilities, factoring in what's happened in the past, where are we today in terms of interest rates, currencies, GDP, inflation, and then from there, we're able to come up with these probabilities. So think of each one of these little buckets as a roughly 25% possible outcome in any given year. So what I like to focus on is that middle line, because that's basically 50% of the time. So using the long-term pool as an example, 50% of the time in any given year, we would expect the return of this pool to be somewhere around 5.2%. In a great year, we'd expect it to be somewhere in that top bucket, maybe as high as 34%. But in a bad year, maybe somewhere down closer to negative 18%. So it really shows you that it's a pretty wide range in possible outcomes. So it's very difficult to forecast what's going to happen over the next year. But hopefully this provides you with a little bit of information in terms of the backstory, in terms of how we come up with the asset allocation, how we come up with the expected return, because we are very focused on risk, as I noted earlier, and you have to think about all the underlying risks that are associated with each underlying strategy. So for example, on this page, and I apologize, there's a lot of numbers, a lot of asset classes that are listed here, but I kind of wanted to put it all on one page for your benefit. I know this presentation will be shared if interested also, but you can see that you're just focusing again on the long-term pool as an example. You can see that our total equity exposure is about 55% currently. Our total fixed income exposure is about 16%. So we're intentionally relying more on the equity markets right now versus the fixed income markets, right? We know we're in a low interest rate environment right now. We do believe that interest rates are going to remain low for the foreseeable future. The Federal Reserve has made it very clear they're going to keep rates long, be very accommodative for at least the next few years. And so what we're also doing now is that because we do believe that it's possible equity market returns as well as fixed income returns could be lower than what we've seen over the past decade, recognizing where some of those valuations are, we've been leaning a little bit more now towards the alternative area. And so that's at that bottom left-hand corner. You can see everything from private real estate to private equity, to some hedge funds, to structured credit, some distressed energy bonds. So roughly 29% of the long-term pool is geared towards these alternative investments. And why do we do that? Because we believe in many cases, a lot of those asset classes are likely going to provide higher rates of return over the next market cycle. And the other key word is diversification. We think that they will help provide some diversification, recognizing the challenges that we're going to see in fixed income and recognizing that we're probably going to see a lot more stock market volatility as we go into 2021, especially recognizing that the health crisis is still in full force. So my last topic before I'm going to turn it back to Julie is talk a little bit about sustainable, responsible investing. I think it's a really important concept. I know that many of you listening in today have a strong interest in this area. And so the way I describe SRI investing is you can really think of it in three buckets. You can be exclusionary, where you decide you don't want to have specific investments in your portfolio or negative screening. So for example, sin stocks. You can focus on ESG, or environmental, social, and corporate governance strategies, where now, regardless of what industry you want to invest in, you want it the best in class. You know, those companies that are doing the best things for their employees, for their beneficiaries, and their overall business models. You know, strong balance sheets, for example, just doing good for the environment, things like that. And then lastly would be impact investing, and that's what I'm going to finish up on. So impact investing means now you're taking dollars and you're putting them directly back into the community, and you're focusing not just on financial returns, but you also want social returns. You want to see your benefits to your community, whether it's in affordable housing, whether it's micro lending to small businesses, so things like that. And so more recently, we did a survey with all of our clients across SEI to get their feedback of what are the most important themes that you see going forward. And interestingly enough, the top 5 voted themes that came back, and this was just done a few weeks ago, was number 1, the future of work, right? Just like we're doing now, we're all participating today in a virtual setting. So I think many are interested in, well, what does the work environment look like going forward? How do I capitalize on that in terms of an investment strategy? The future of food, you know, there's still parts of this world that are experiencing hunger. And how do you get food to those types of countries, or just overall food with you know, biogenetics and agriculture? That was option number 2. Number 3 was the climate. I mean, we're all here on a daily basis hearing about, you know, what's the climate change going to look like. And then lastly would be, you know, plastics, the circular economy, and then looking forward in terms of technology and how do boards, you know, function with respect to whether it's a nonprofit or whether it's a for-profit institution. And so, as I said earlier, ESG can fit into a lot of different buckets. I won't spend too much time here, but think of it as, you know, positive investing. You're really trying to find the best in terms of companies, whether it's environmental, social, or governance strategies. So the one manager that we've recently added, and this was literally in the last month, is a company called Community Capital Management. And so I know it's hard to read the screen, but I'll just verbally tell you what you're looking at here. And so this is a fixed income manager. And so what they're able to do is we are able to, you know, give them dollars, and they'll take those dollars and they will select different themes to make their investments. And more importantly, they will also direct those investments to wherever you want as the investor. So for example, we selected that these monies be directed directly to Miami-Dade County, and more specifically in the surrounding areas of Miami. And so, you know, all these topics could be covered, you know, whether it's affordable housing, you know, whether it's, you know, other areas, you know, like healthcare and other social, you know, interests. And so it's great. They'll, on a quarterly basis, they'll provide us with an update in terms of the investments they've made. And then on top of that, I think we all know about diversity. That's been a very interesting topic this year. We understand that many of our investors, you know, want more exposure to minority-owned businesses. And so CCM also is able to do that, you know, in terms of, you know, investing in businesses that are minority-owned or operated. And so that's another thing that we'll be focusing on, not just in our social impact pool, but across all the pools as well. So with that, I'm going to turn it back over to Julie, and you know, we'll look forward to getting more questions.
Hi, everybody, I'm back. Okay. Glenn, great job, and thank you with that overview of the work that SEI has been supporting for the Miami Foundation. Just a couple comments on some of the slides that you had covered. First of all, the socially responsible investing. What really encourages me quite a bit is there's been such an evolution in that area that now we can incorporate into our regular portfolio socially responsible investment strategies and not give up investment returns. Glenn, that's one of the evolutions we've seen in that area is, as an investor, we do not have to give up that financial return in order to have that positive social impact. And so one of the things we will continue to do as an investment committee is identify those types of managers that now are in every asset class and strategy that we can incorporate into the various pools. So that was point number 1. Point number 2, Glenn, I just wanted to add, one of your slides talked about the long-term investment returns for each of the investment pools. The largest pool we have is the long-term pool, and that's the one that, as I said, is the largest, but also has generated an average return of 8% based on the work that SEI has been supporting the foundation with. What does that 8% mean? Well, each year as we think about our pool of capital, we want to be able to provide grant making, and that's what we call generally our spending policy. So that covers our grant making plus the cost to run the foundation. And that's roughly around 4% on any given year. Then we have to factor in inflation. Inflation has been very much in the news because it's generally been under the 2% level where the Fed would like it to be. But nonetheless, we have to think about the purchasing power of the dollars we have and how far they can go in the future. So we factor that 2% in, and then there's fees. You didn't talk about the fees, but SEI has done an excellent job in terms of putting together these pools of managers in a very attractive fee format so that we're not eroding the principle of the foundation, but we have to still factor in those fees. So when we add in all those withdrawals, if you will, we've got to generate somewhere between 6 to 7% on average over time to meet those goals of grant making and covering the various expenses of the foundation. And you've done a good job, Glenn, through SEI and really helping us keep on track. But I wanted everybody to understand there's a very specific methodology in order for us to meet our financial objectives and outcomes. You agree with that, Glenn?
I agree 100%. And as you were talking, I just realized the other thing I didn't point out was, I mentioned earlier on that we launched that index pool in the first quarter. And so I know there might be some investors that, have found it very interesting to want to focus on passive investments. And so, we would agree that there's been a challenging environment for active management as it relates to the United States. And so we, as you may recall, we have exposure to active and passive strategies in all the pools, actually. But the index pool would be, geared for those investors that want just passive. And so I appreciate you mentioning that because you're right. I mean, not just the index pool, but all the pools, we have a keen eye on making sure the expenses are low, making sure that we can keep building each one of these pools and making sure we're still able to cover all the key metrics that you just noted.
Thank you, Glenn. So now I'd like to kick it over to the other panelists in today's program. And I'd like to kick it over first to you, Joe. There have been, a number of questions that have been sent in regarding macro themes, the macro environment, and you are a very seasoned investment professional and have, very strong insights that I think people would benefit from. So I'd love, Joe, for you to please talk a little bit about some of the macro themes.
Sure. So let me, thank you, Julian. Let me start with, I think what's on many people's minds, which is this new world called the post or during pandemic world. And, lower interest rates as governments have stepped in to fund their economies during this crisis. What does that all mean? And Glenn earlier talked about, some of the divergences where much of the performance that's come in major indices has come from a very select group of technology or pandemic related stocks. And there's huge segments of the market that have not participated or even recovered to where they were pre-COVID. So first of all, I think we probably would all agree in hindsight that the government funding, the economy and to attempt to shore up unemployment, whether that was here in the US or in Europe, and to try to stabilize the economic situation was a very intelligent move. The potential for this pandemic to have caused a disastrous economic situation was really, really clear. And the governments moved quickly, if not in the most orderly fashion. And of course, we had central banks stepping in to stabilize markets in ways that many people don't understand. So, number one, there's this great book by a couple of economists that say, this time, the title is "This Time is Different," and the point of the book is that it is never really different. They're always the same. Well, I would suggest to you that this has been a little bit different because this pandemic has driven all sorts of interesting thematics through the macro economy. For one, think about what we're doing right now, right? This was a trend that was slowly evolving in corporate America and in other areas, video conferencing, reducing travel expenditures, et cetera. Well, in 7 months, we accelerated what probably would have taken 5 years to do completely into something that happened very quickly and we all got very comfortable with. So that has implications for the investment world and how things are going to evolve. I think at the opening, Rebecca talked about, we're shopping differently, right? Bricks and mortars have been on a downswing for a while, but today we are all very comfortable with Instacart, Uber Eats, and all the various other options that show up at my door every day. So this has been, from a macro theme, a point in time of acceleration of things that were already evolving. And so to some degree, we don't fully comprehend yet how all of this is going to play out for corporate earnings, for employment, and for the economies in general. Second, I'd say from a macro theme, governments will have to continue to support their economies for some period of time, and therefore interest rates are likely to remain low. Certainly the central banks are signaling that way. And what does that mean if you're a fixed income investor? If I can't earn a reasonable rate of return on my bonds, what options are left to me? And the government is in effect forcing you into risk assets in order to do that. And how do you balance that equation like Glenn has done for us across the investment portfolios? And then thirdly, I think a lot of people worry about debt, right? So the governments have financed all of these bailout packages with debt, and the level of debt on balance sheets in developed economies has gone through the roof. What is the implication for that in terms of inflation in the future, and how will we address it, right? And so from a macro thematic point of view, you have all of these unknowns, and it's just not one unknown, right? In 2007, the unknown was, will the banks fail? In 1999, was it, will the technology companies recover? Here you have a set of unknowns that I think folks like you, Julie, and Glenn and Angela and I will be talking about for a while, trying to figure out what the direction is. But those are the macro themes. And I think, we have a number of ways to help people think about that in their specific situations.
Excellent, Joe. Great insights, and thank you for sharing them. I realize that this has been, and we've been talking about an era of deep introspection on investment planning, but also on other fronts, there's been really deep introspection. And Angela, I kick this off to you because this has been a period where individuals have thought about, well, is my wealth transfer planning in place? Or there's people in need. How can I address, that need in terms of my philanthropic giving? There's strategies out there that perhaps I should be considering. So it'd be fantastic, Angela, if you would share some of those insights with us.
Yes, absolutely. Well, I will tell you that this time has been so unprecedented. I mean, young and elderly individuals started to contemplate their mortality, which, really has never been in the forefront of our minds. It created a worldwide crisis of a magnitude that really most people have never experienced. I will say that clients started to think about loved ones and trying to figure out and make sure that they are taken care of, and their estate planning became a really big priority. So not only were we having conversations with clients about amending and restating revocable trusts and, creating new wills and codicils. But we've been talking a lot about wealth transfer to the next generation. There's been a lot of talk about grant or retained annuity trusts for transferring wealth without using gift tax exclusion. And I think that as far as philanthropic giving goes, at the onset of COVID, people were really putting philanthropy as a priority as well. Donors wanted to give quickly and they wanted to give efficiently. And so they were looking for ways to be able to do that. And I'm sure that all of you have heard about some strategies, and I encourage you after our discussion to discuss them with your financial advisors, your attorneys, and your CPAs. I'm not an attorney or an accountant, and I don't give tax or legal advice. So I think that's really important to remember. But two strategies that I have really seen a lot of and are probably the most common besides the direct giving are donor advised funds, which, as we all know, the Miami Foundation manages, a very large one, and also the creation of family foundations. There are pros and cons for each, and it really just depends on what your charitable intent is, your personal preference, and your financial situation. There are also some really good strategies around charitable giving trusts. So, charitable lead trusts where the organization gets income, initially, and at the donor's death, it's distributed to family members. There's also charitable remainder trusts that donors can think about creating, where the beneficiary gets the current interest income. And that's important for some people because they want to make sure that they're philanthropic, but at the same time, they rely on that income. So we find that's been one that I've seen really put into place most often during the last few months. I think it's really important to remember that the CARES Act was put into place this year. And what does that mean? It means that if you itemize your deductions, then you're not limited to your AGI limitation. So really what that means ultimately is that you're effectively allowing to zero out your US taxable income. And that's only for 2020. So for people who give charitable donations, this is the year to do it. Not only are charitable organizations in dire need of funds because a lot of organizations had to cancel their fundraisers, including the Junior League of Miami had to cancel their galas. So it's a great time to do it, and there's some tax benefits to doing it. I will mention that this doesn't apply to gifts to donor advised funds. It's basically applies to cash gifts directly to organizations. So if you are a charitable organization, you should definitely be talking to your donors about this. Those are a few strategies I think that everyone should be considering at this point.
Yeah, no, that's really helpful, Angela. And I think what's important is, making having an impact and fulfilling some level of charitable intent can happen on every level. And that's frankly the beauty of the Miami Foundation. While those of us that are on the panel work with individuals and foundations that have millions and millions and maybe billions of dollars of financial capital, the Miami Foundation allows one to set up a donor advised fund on a level that's just a matter of several $1,000s. So I think the beauty of philanthropy and practicing it can be done on all levels. And again, this is not about making necessarily a commercial for the Miami Foundation, but I will, in terms of your leveraging impact. Rebecca had mentioned, some of the work that's just been done this year, the Community Recovery Fund, which was created, right after the lockdown occurred, because we saw, as Angela just said, many of the local not-for-profits that are doing really important, providing important services in the community were really struggling with the additional PPE equipment, you know, the reduction in staff that they had and other requirements. That community recovery fund is all about being a vehicle to help the not-for-profits in the Miami community. Fast forward a couple of months, you know, we saw, you know, the protests and the tragic events that happened, you know, around racial inequity. And so we launched a racial equity fund. And that fund is making grants to some amazing people in our community that are doing really profound and important work. So even with a matter of a few $1,000s, you can touch many people in the community through your donor advised fund and through your giving. So I encourage everybody who's on the call, irregardless of your financial capacity, you can make a difference in our community, and just want to share that. Moving back to investment topics. You know, there have been several questions that have been sent in and posed to us around the value of US versus non-US, and is there any merit in terms of incorporating those types of strategies into a portfolio? Glenn, we've had discussions about that at the investment committee level. I would love for you to share some of the perspectives that SEI has on the inclusion of US and non-US.
Sure. No, that's a great point, Julie, and appreciate the question. I would say that, you know, if you think about, we've all been talking so much about COVID and the impact it's having on a global basis. If you look at the most recent real GDP, so gross domestic product of companies around the world, you've got areas, particularly in the Far East, like China and Taiwan, that actually posted positive real GDP in the most recent quarter. And you have other areas like South Korea, Indonesia, and Australia that actually are only, you know, slightly negative over the last 1 year period. And a lot of that is correlated with the fact that those countries went into a strict lockdown mode and certainly continue, you know, practicing social distancing. And so, you know, from our perspective, that's a great example of, you know, looking to, you know, maintain some investments outside the US. You know, there's so many, you know, decent companies that are based in these particular regions. The same could be said for select European countries as well. We've all seen the numbers. It's not just the last 1 year. You have to go back, you know, 5, 10 years until you actually see some extra or additional excess returns, you know, coming from investments that are based outside the United States. Yes, there are certainly areas right now that are being challenged because of COVID. I mean, prior to COVID, you know, India was a fantastic market to make investments in, but they're obviously seeing gigantic increases in terms of COVID right now. But at some point, you know, when we get past this, you know, who knows when that'll be. But countries like that, I mean, same could be said for a lot of Latin American and South American countries that are also going through a rough patch right now because of COVID. But again, this is just an example of looking to diversify your investments, because our active managers will look at these regions and they won't base their decision necessarily just on what's happening economically, looking for those companies that maybe have, you know, global trade practices or are able to actually export goods to other developed nations as well. And so that's part of the reason why we like, you know, having exposure international. And just from, I made that comment earlier about valuations, and just the valuations for non-US are so much more attractive than the US right now. And I think this year just happens to be one of those unique circumstances where everyone's been caught up in what Joe was talking about, you know, the FANG trade and the stay-at-home trade. And at some point, we'll go back to what I was saying much earlier about the reopening trade. So again, I'd say the portfolios now are still leaning a little bit more towards the United States, but we certainly have a fair amount of exposure to international, more so on the equity side, but we also have small slices towards the debt side as well.
And Glenn, while I have you, just to finish your comment, when you look at 2020, kind of the attribution on a high level that resulted from the different asset classes and diversification, any high level comments you can share with the group regarding what was additive, what was a detractor?
Yeah, that's a good question here, and thank you. I see that came through. You know, so I think for this year, so far, year-to-date basis, January 1 through even the current day as of yesterday. What's been helping has been certainly the U.S. equity overweight. As alluding to earlier, we have exposure mostly to passive on the U.S. large cap side. So that's a wash, if you wish, or it's neutral. Some of our small cap managers had a little bit of a tough go this year, only until more recently, primarily because of what I was saying earlier, focusing on companies that have more attractive valuations and fundamentals, companies that are actually making money, for example. You haven't seen that in the small cap space. A lot of it is also there's been a lot of momentum trades. So small cap, again, a small piece of the long-term pool, but a little bit of a detractor. Another piece I would say is, remember I was saying earlier about the low beta trade. And so we intentionally have some exposure to what we call a global managed volatility strategy. So that's where we load up on more defensive sectors. Think of utilities, think of consumer staples, and we shy away from information technology. Because again, you want to have exposure to companies that have more dividend yield and less volatility or beta relative to the broader markets. And so that's been a little bit of a detractor in terms of relative to benchmark. But I would say that the vast majority of other funds have done quite well. Our international strategies have outpaced their benchmarks quite significantly. Same could be said for our risk management fixed income, like our core fixed income fund. And then really depending on how you look at alternatives, as I showed you all earlier, real estate has done fairly well relative to benchmark. So from an attribution standpoint, that's been additive. Distressed energy, probably not surprising to everyone on this call today. We've seen what's been happening in the energy markets, certainly with the demand destruction as it relates to jet fuel, right? Not many people are flying right now with the complete economic shutdown, essentially in the second quarter. So oil prices took a big hit. And so we have an investment there where it's put in perspective. It was down, call it 20%, going into the first quarter of this year, and it's come back over 15% just the last 2 quarters. So again, a little more of a volatile strategy. That's why we have only a small piece in the entire long-term pool. There's not really a great benchmark for it per se, but because of the fact that the closest benchmark might be a high yield energy index, it's been a little bit underperforming that. So it's little pieces that have kind of added up to what have maybe hurt the portfolio, but the pros have clearly outweighed the cons.
Thank you, Glenn. And shifting gears a little bit, Joe, you provide advice, for taxable type of entities, wealthy families, their structures they set up for wealth transfer planning purposes. What is some of the high level guidance, and points that you're incorporating into the advice that you're providing to your clients around really sustaining the wealth that they have and enabling them to meet their objectives, whatever they may be?
Thanks, Julie. And I'll key off something that Angela said earlier and tie it back to the interest rate conversation as part of the macro themes. In a low interest rate environment, when treasuries are in the 1-ish% range and maybe municipal bonds, if you're fortunate, are sort of right around there as well, I earlier said that what you end up doing is being forced into risk. However, with a thoughtful plan, one of the things that you can do is combine your philanthropic intentions and your need for income flows together for the benefit of both the charity and yourself and your family. So, for example, Angela mentioned the charitable remainder trust. In a period of time where folks have had some good performance and perhaps they have some appreciated stock in the portfolio, they can put it into a charitable remainder trust that pays them today 5% in income flows every quarter, but leaves the residue well invested by people like Glenn to a charity or charities of their choice, including the Miami Foundation. That was an unpaid commercial. So the point is that the things that people worry about today and about the future is transferring wealth in a way that's tax efficient, that allows them to avail themselves of their philanthropic intent without diminishing the cash flows that they need to maintain their lifestyles today or to support their families. And also, I think from a values perspective, to instill the notion of philanthropy and community into next generations by using vehicles such as these. Of course, tax planning is an important part of what we do every day, day in and day out for taxable investors. And there are a number of structures like that and variants on that theme that have become really important parts of wealthy families' plans into the future.
Thanks, Joan. Really, really valuable insights. And you touched on wealth transfer planning, which brings me over to you, Angela. You know, that your focus is really working with your clients on a day-to-day basis and really helping them achieve those wealth transfer planning dreams, goals, and objectives. And, you know, in the course of your work, where are you seeing kind of some of the success stories in terms of best practices of what you see, you know, those successful families in the sense successful in achieving their objectives? What is it that you're seeing them do that helps render that success?
Well, I would say, you know, first off, as your question to Joe is not to be an emotional investor. So come up with a long-term plan and stick with it. So if the market has a downturn, there's tactical changes that can be made, but you know, don't make decisions solely based on emotion. And I think that really sets the standard and a foundation for being a healthy investor. As far as strategies that we've seen that have been really impactful for our clients, right now the 75-20 rate is extremely low, which makes the grantor retained annuity trust something that our clients really like. And for those who have already used up their gift tax exemption, it's a great way to shift appreciation to the next generation. The AFR rates are also at a historic low, and you know, we've seen a lot of people use intra-family loans. You know, individuals who give money, who loan money to their children so that their children can invest, and then their children pay them a small amount of interest in return. And so those are some of the things that we've seen. As far as estate planning goes, right now, what I think has really been top of mind for a lot of individuals are the SLATs, which are the spousal lifetime access trusts. So basically what happens is individual husband and wife give each other a set amount of money, you know, different provisions enough to make it different, because if it's too similar, then the IRS will have a problem with it. But for those who can give right now, that's a great tool, because the spouses still have access to the funds should they need it, although they shouldn't plan on benefiting from it. But it's a great way to utilize the 11.58 estate tax exemption that we all know is going to sunset at the end of 2025, or the sooner of whether or not, you know, we have a change in office. So I think really clients are focusing on utilizing that 11.58 right now as an individual. Otherwise, you know, they're going to lose it. So I think that a lot of our conversations have been about how could I utilize estate tax planning? What's the best method for me? And I would say that it really all depends on your wealth, your assets, and your personal preference, how much you're comfortable giving, and also, you know, if you have a philanthropic intent. But all, you know, I think it's a very big discussion, and it's very unique to each individual. So there's not one set plan for each person.
But I think that the common theme for everybody is one of the few areas where you can really optimize tax benefits is around charitable giving, right?
Absolutely. I think that there's just so many ways to utilize, you know, the charitable deductions, and also, you know, through the different trusts that I mentioned earlier. I know that donor advised funds, I think, are just extremely popular right now, and they've been popular probably for the last 10 years. I've worked with the Miami Foundation and their donor advised fund, and I think that it's a great vehicle for those who are unsure of who they, what organization they want to give. And as I mentioned, the charitable remainder trust and the charitable lead trust, the beneficiary could be a donor advised fund. So you can actually utilize two different strategies to be, a maximum benefit.
Mm-hmm. And what I might add is nothing is mutually exclusive. I also have clients who have private family foundations and donor advised funds, and they use the donor advised fund as the vehicle to collect the annual required distribution from their private foundation so that they can more thoughtfully enact their grant making. So there's a lot of synergy, between the different strategies. Shifting gears a little bit back to an investment topic, one of the things, Glenn, that you touched on is an allocation that we have in the long-term pool to private illiquid type of investments. And, the general rationale for doing that is trading illiquidity, or we're giving up liquidity in expectation of a higher return. As we look across the spectrum of private equity or less liquid type of investments, we've seen really a lot of movement this year, be it on the venture capital front, the middle market buyout front, the real estate front, the distress front. I know there was a question about private equity in South Florida, and there are a number of firms operating out of South Florida, some for decades, that have been very successful investors in their specific areas. But the question I want to throw is, you raise the point, it's important to invest for different outcomes, right? And not rely on a binary outcome. If everything is invested the same way, well, you're going to have one outcome or the other. So the thought behind the private equity is really to try to diversify as well as enhance the overall return outcome. Glenn, can you share some general perspectives in terms of what SEI is seeing on the less liquid front? And then I'd also like to get some from Joe once you're done.
Sure. No, that's a great point. So I think I'd start off by saying, going into private equity was actually the first time that I'm aware of that the Miami Foundation has done this in the last, more recently, in just this past year. We've made some commitments to, as you said, Julie, some great managers. Our view when we look at investing in private equity is a couple of things. One, I would say that from our capital market assumption standpoint, which I was talking about earlier, if you look out over the next 10 years, we believe that private equity will probably be one of the higher sources of returns relative to, say, public markets being equities and fixed income. And so in other distressed areas, I kind of alluded to energy a couple times. So within our private equity portfolio, what we do is we focus more on niche type managers. So there's some great, huge private equity firms that I think everyone on this call is aware of. We typically don't go directly with them. We try to fund managers that are in that 150 to $500 million range. And so it gives us a lot more flexibility in terms of timing. And we like the fact that many of these managers are able to provide distributions in a relatively quick fashion. So what I mean by that is you make a commitment today, within a couple of years, you're already seeing some distribution coming back because of the underlying, their underlying portfolios where they already have some gains. And so you're right, venture capital has definitely been a more interesting space more recently. Certainly the buyouts, you alluded to it quite nicely. Those are definitely who we're investing with now. In our private equity fund vehicle, we've made 3 underlying investments so far in 2020. In the name, just kind of, if you're curious, for those that are in the private equity world, firms like Lightspeed, Redpoint, scale. These are all landmark, real estate. These are types of managers that we really like. We've been working with them for a number of years now. And we've done very well in our previous series of private equity funds. So again, the key point is, higher returns, hopefully over the next 10 years, certainly investing with managers that provide distributions in a shorter time horizon, and certainly investing in those areas where the best opportunities are. So we all know about technology, biotech, real estate, energy. And I'd say that's primarily our focus right now here in 2020, going into 2021.
Yep. So not surprisingly, to add to Glenn's point, if you think about the stocks that lead today, the FANG stocks, they were all incubated in private equity before they came public. And so, I think many have commented on the fact that private equity returns and public equity returns have begun to converge a bit of late. But I would submit that, to Glenn's point, if you find really good managers that can identify the opportunities in these private companies, fund them through the incubation period to create revenues and bring them to the masses, as it were, the opportunities for investors are very, very strong. The other thing I would say, and when you're talking to private investors in private equity, you want to season your private equity investments. So it's not a one and done, like I buy, shares of IBM today. I want to invest in a series of private equity funds because you don't know which one is incubating the next Facebook, Google, Netflix, or whatnot. So some key points to remember: that private equity, like anything else, is something you have to do consistently, do it in a diversified fashion, and do it across managers that really understand what they're doing.
The only other thing I would add to your points, Joe, is that it's important to really get the proper guidance to select private equity fund investments, because there's a huge dispersion of returns from the top private equity managers to the bottom. And if you select the bottom ones, you actually would have been better off just staying in liquid strategies. So it's really, really important to get professional advice and guidance on that selection process.
No question.
And so, Angela, back to estate planning. And I don't know if you have a point of view in terms of private equity and kind of some power or synergies that can be utilized in terms of taking private equity interests and utilizing them in various vehicles for wealth transfer planning.
Yes, so I would say that any asset that's going to appreciate tremendously is a great asset to gift to a trust for, for a child or for someone that you're making, you're creating the trust for. Once you gift an asset at the lower level, the market value of the gift is going to be the current value. And so, typically with private equity, they appreciate tremendously over time. And so that's exactly the type of asset that you're looking for when you gift to trust and to the next generation. You want an asset that's going to appreciate, not an asset that's going to depreciate, because otherwise, you're losing out on your gifting amount. And so I would say, also from the perspective of liquidity, if you do gift private equity, that there are liquidity limitations. And so if the intent is to allow the beneficiary to withdraw from the trust, it may not be a good asset. And I would also just say that for some trusts, it's probably not a great asset because of those reasons. So I think it goes back to my original statement. It just all depends on what the intent is, and what strategy you're using.
Thank you, Angela. And so as we move towards closing today's dialogue, I think it might be helpful just to, while we talk about how different things seem and kind of the volatility of the year and the things that have happened, Angela used the word unprecedented. That word was used so commonly, you know, particularly once we got into the height of the lockdown. But when we look back, and I've been through several of these cycles, what seemed so unprecedented at the time, actually, there's a reversion back to the mean in terms of potential outcomes. So that takes us back to what we're here about today talking about, which is the foundation pool of assets and the fundamentals that we're applying in terms of asset allocation and how we're approaching managing the pools, you know, for the endowment, for the donors. And so one parting thought I think each one of you could share around really the importance of not getting caught up in the noise and focusing on fundamental analysis. So let me kick it off to you, Glenn.
Okay, well, thanks, Julie. I think, you know, from our perspective, it's really about, you know, looking for companies, I've said a couple of times now, looking for companies that have reasonable valuations, have attractive fundamentals, sort of looking through, you know, the balance sheets and financial statements of companies that have been overlooked this year. I mean, I know there's certain segments of the markets, obviously, that are going through a challenging period, like the airlines, like the restaurants and bars, et cetera. You know, other leisure and some select retail companies. But I do believe that, you know, I don't want to sound like Dr. Fauci right now, but if we do come up with some kind of safe and clean vaccination, I really do believe that, you know, we will see that reopening trade. And I really do believe that at some point, you know, many of these industries, many of these companies will come back. So again, it really depends. Again, it really depends on where we go with the virus. And as you know, with the portfolios, we are constantly managing them, focusing on risk management, trying to identify what the risks are going to be. We do believe we're going to see some more volatility in the near term. I mean, this whole week has been all about stimulus, right? Are we going to see a stimulus package again? And that's what markets are sort of banking on, and that's why you're seeing the markets up the last couple of days. And then, of course, you know, the election can certainly make things interesting as we go into the final months of this year. So with that, you know, I'll turn it over to you know, to Joe and Angela to provide their closing comments. Thank you, Julie.
Thank you, Glenn. Appreciate that. Joe, closing comments to share. You've been a big macro contributor today, so would welcome your closing comments.
So I'll get macro and really old, right? The economy is a vehicle for constructive destruction, and over time, things that we feel are terribly disruptive and could, you know, mark, you know, the end of the world, in quotation, so to speak. So think about, you know, the end of the blacksmith when the car was invented. Think about, you know, the demise of the candle maker with electricity, and the ice delivery man with the advent of the refrigerator. So we are in a period of constructive destruction. And like Glenn, I believe from a macro theme, we will shake out of this period of time more resilient and better for it as an economy, and focusing on where those opportunities are today in maybe where the death of certain sectors has been much exaggerated, might be the opportunity in the coming years to play that reopening trade and a return to normal. So, you know, my advice to everyone from a macro perspective, take the long view, because the market will always surprise you with its resilience.
Correct. Thank you, Joe. And Angela, parting thoughts that you have to share with our audience.
I think what Joe said is perfect. We're gonna make it through. We're gonna be resilient. You know, stick to your long-term plan. I know it's hard to not get caught up in all of the noise. I know that there is an upcoming election and things could change, so be prepared, but you don't need to act just yet. Speak to your attorneys, speak to your accountants, come up with these strategies that may be right for you and your family. And if you need to act on them, you'll be ready to act on them once things start to change. But try not to panic, stay the course, and, you know, just be ready and be prepared.
Mm-hmm. Very sage advice, Angela. Thank you. I think some of the common themes themes that have come out from all of you is plan. So having a plan is a starting point. If you don't have a plan, you don't know where you're going and you don't know how you're going to get there. So whether it's wealth transfer planning, tax planning, or investment planning, the key is really take the time, work with your professionals, and have a plan. Very much how we review and revisit every quarter in our investment committee meetings for the foundation, our asset allocation plan. How are we doing? Has anything changed? Secondly, I think you both brought up, try not to get caught up in the short-term noise, right? There's always events that will happen. And I recall a slide that actually JP Morgan had produced that talked about all the disruptive things that have happened since Y2K in 2000 and the S&P 500. And if you just stayed invested and didn't react to all the different events that happened along the way, you would be much better off in terms of your total investment outcome. So don't react, don't be emotional. But the third point that I think you all raised is evaluate. So make sure that you're on track, make sure that something hasn't changed in terms of your goals, objectives in your life, as well as look at what's happening in the broader world. Has there been some event that has changed your plan that you need to revisit? And so I think, with that, I will thank everybody who has joined today's discussion. I really want to thank Glenn, Angela, and Joe for the sage, the thoughtful commentary and advice. Hopefully those of you that are on the call see we have some high quality professionals and individuals that are involved in the Miami Foundation, involved in helping us with the investment committee work and really looking out as fiduciaries and for the greater interest of the foundation and the Miami community at large. So I thank each one of you for all of your contributions, not only to the investment committee, but to the Miami Foundation and our Miami community in general. So thank you all.
Thank you.
Thanks, everybody.
Have a good rest of your day, everyone. And thank you again for joining the program.